Welcome. We'll get started shortly. Before we begin, here's how to earn continuing professional education credit for attending this session. There are no polling questions or attendance checks. Instead, you will demonstrate your knowledge by taking a brief multiple-choice quiz using the Earmark app. Visit earmark.app in your web browser. You can also download the mobile app by scanning the QR code on the screen. Log in, or if you're new, create your free account. Be sure to use a valid email address because that's where we'll send your course completion certificates. From the home screen, scroll down to find the course. You can also tap the magnifying glass icon to search for the course. Tap on the course artwork, then the Enroll button. On the Course tab, you'll find the recording and quiz questions. Complete the quiz to earn your CPE certificate. It takes us a few days to create the course on the app, so if you are attending this session live, please wait a few days. We'll email you a link to the course when it is ready. If you have questions or need help, email us at support@earmarkcpe.com. And now, on to the event.
Hello, everyone. Thank you for joining us today or watching this webinar on demand. I am Zach from Earmark, and welcome to Rebate Accounting Errors Risk Auditors Can't Afford to Overlook. I want to welcome you to your hosts today, Mark and Kevin, so please take it away.
Thank you so much, Zach and Kevin. Wow, we're going to be talking about rebates, audits, accounting.
It's what we love to do. That's I think that's why we put on this planet, wasn't it?
Yeah. We could probably talk for hours, so we're going to have to dive straight in. I know auditors, they've got hourly billables, so we don't want to waste any time with this process. Bring back memories.
Of course, yeah, those timesheets, filling out 5-minute segments of every day. I feel your pain, guys. So yeah, I've been there before.
Yeah. So Kevin, to start with, we're presenting about rebates. We're talking about audits, but I would say this can be whether you're an auditor or you're going to be audited. I think the message is just as important for both sides. But looking at what I'm seeing on the slide here, I think it's pretty explainable or explanatory why. But do you want to just dive into a bit more detail about why this is so important?
Yeah, absolutely. You can see from the headlines in front of you right now that there are lots of instances where rebates cause issues for companies and, by extension, auditors. We'll explore some of the reasons why this happens, why rebates can present these issues from an accounting standard, meeting the requirements, and also why auditors, when they're faced with rebates, can find it quite difficult to ensure that their audit work is substantial enough and suitable to ensure there is no material misstatement in those rebates. There's some big names on the screen, some big numbers in terms of the implications of what happens when a company's rebates are found to be misstated and when an auditor fails to spot that misstatement.
And I think what's really important now is we're seeing more and more pressure on the auditors. Where we've seen businesses fail just after an audit, the kind of the regulators and the stock markets are really starting to put the pressure on the auditor to say, well, hey, these things can't happen.
Absolutely.
And so with that in mind, we know that rebates are often a massive part of a business's profit, whether it is paying out the rebate or whether it's receiving the rebate. And so what we're going to talk about today is that kind of full spectrum of rebates. And so when we think about why it's difficult to get it right, we know that accounting just generally, it's not easy, and it's why we have auditors as well, because these things are complicated. However, rebates, I think, unfortunately, take the risk to a new level. Do you want to talk through kind of this idea of siloed processes? What processes is it, or are there, that are actually siloed?
Yeah, so if we think of the rebate agreement or the life cycle of a rebate from cradle to grave, to coin a phrase, from the very inception of those rebate terms, when the procurement team, if we're talking about our purchasing rebates, or the sales team, if we're talking about sales rebates, all the way through to the accounting for those rebates, the accrual, the accurate allocation of the rebates, and through to realizing cash or making a cash payment, there's different teams involved in that process. And if those teams at the beginning of that process, your sales team or your procurement team, depending on which side of the coin you're dealing with, if they're working in a silo, making agreements with trading partners without sharing that information, particularly with the finance team, if they can make a contractually binding agreement with a trading partner without making that visible to the finance team, then you have that classic issue of the finance team trying to manage a secret or trying to accrue a secret. They don't know what they don't know, and if the initial team doing the deal is working in a silo, then finance almost have no hope of accurately and completely accruing the rebates.
Right, and I believe it's probably, in my opinion, the biggest risk that I've encountered is that problem of, do finance actually have all of the information? That in my career working with rebates, even with the most mature processes and controls, you're still relying on people to either follow a process and just think, have I told finance that, do they need to know this information? Because we know the biggest data repository out there for most businesses is Microsoft Outlook. And unfortunately, that is not the best way to share this information. So we move on to the next one, which is very much more accounting focused. Oh, sorry, we've gone one slide too far there. Accounting estimates. That can be challenging. Most rebates, thankfully, are quite straightforward. It's you have to meet certain requirements, but estimates are required. Can you give an example of a few of the estimates that you might need to make?
Yeah, absolutely. So as a period of time that the agreement period is rolling on, we're currently constantly having to reassess how we think we're performing against the terms in the agreement. Think classic incentive rebate terms: hit a certain banding, earn a certain rebate. 3 months into the year, perhaps we think, looking ahead, we're going to have a busy summer. We're going to kick on from our current position. We don't just extrapolate in a straight line. Instead, we're going to have a much busier next 6 months than the 3 months to date. And so we make that estimate looking forward that we're going to hit the top banding, and that's going to earn us 5% rebate. So the right thing to do at that point in time, if we truly believe that that's what we're going to hit, is to start accruing that 5% rebate. If we reassess that picture 9 months into the year, summer wasn't as busy as we expected, and therefore we haven't hit that top banding, our initial estimate was incorrect, then we've potentially been accruing at the wrong level. Even worse, as we get to year end, that estimate of hitting the top 5% banding hasn't come to fruition. We don't notice that in our year-end checks and reviews, and that's the number that stays in the accounts. Whether we're claiming that rebate again or whether we're paying it out, the accrual that we've made to create a debtor or a creditor is going to be overstated. And so we have made an estimate, we haven't revisited it, and so there's always that risk when we're making these estimates and having to constantly track our performance. There's always a chance that we won't do that, and that we are left with a material misstatement or potentially material misstatement at the end of the period.
And I would say for everybody tuning in, especially the audit side, in a lot of businesses, we produce monthly management statements. Sudden big jumps in rebate intra-year, whilst they might initially appear as a bad thing, is probably a business getting its rebates all set for year end. Because like you say, unfortunately, you're running normally year-to-date calculations. So later in the year, when you have to make an adjustment, you're actually adjusting all the way back to the beginning of the year. So those adjustments are probably good in terms of getting things ready for year end. And I know, for example, Tesco had the challenge was their accounting team had been accruing these rebates all year long. When they realized that these targets were not going to be achieved, and therefore they had to charge their profit and loss account with a huge amount, for some reason, a decision was taken higher up, let's not do that. Which you can understand that pressure. But what it means is, from an audit perspective, I would say look for, if a business had a sudden economic downturn, anything like that, did you see in the year rebate revisions? Because if you haven't, there could be a risk that actually, that they are required.
Absolutely.
So the next one, and it's an area that encouraged me to write a full paper on this, which I've got in front of me so that we can actually go through it in a little bit more detail later. But accounting standards, whether we're talking US GAAP, which is typically more codified, or IFRS, more principles based, there is the vulnerability of interpretation, because our commercial colleagues don't always operate in what we would think as a very kind of linear perspective, or sometimes even what they think is just an innocent amendment to a contract and a simple requirement to adjust something. So a mid-year contract change can have big accounting consequences. So I think we'll go into that in a little bit more detail shortly. And then finally, one for every accountant is familiar with, these calculations typically encompass the entire business is trading. So whether that's their purchase data or their sales data, and depending on the complexity of the rebates, can go down to things like SKU level calculations. Therefore, it's, these calculations are big. If they're not using what I would class as robust software, and they're very dependent on Excel, things like that, there's also the risk that things can go wrong. Even with the best intentions in the world, rebates are hard to manage and calculate.
Yeah, absolutely. And it ties into the point you made on the previous icon there. There are very rarely any guardrails in place, so all sorts of weird and wonderful terms get added to rebate agreements. And so there's no one size fits all way of calculating what rebates are payable or what rebates are receivable. You need to be much more nimble than that and have a flexible system that can incorporate all of these different types of rebate that might exist, which of course just adds to that complication.
Yeah. And so as we press on to the 6 biggest areas, and what I propose here is, we'll go through the kind of these bit by bit, but we're going to get into a bit more detail here, because what I really want the audience to get is, when we used to be audited, I remember the first day the auditors sat with us, we almost had to educate them on how they need to audit us. And I don't think an auditor should be in that position. I think auditors should be ready equipped to know how to audit rebates. It's not easy. There is no, when we studied to become accountants, there is no dedicated course on rebates and things like that. So hopefully these points will really help people. So the first one, and we've talked about this a lot, basically follow the cash is the way I would see this.
Yeah, absolutely. I think this one had to be number one. If you remember the slide that we shared with you at the beginning of the presentation, looking at those headlines, those high-profile cases where rebates have been an issue for companies, there's a common thread there, and very often it is a case of rebates being recognised in the incorrect period. Companies, whether deliberately or not, we're not here to make those assessments. At this time, they are somehow recognising rebate that's due in a future period in the current period. And so that has to be number one, I think, on the auditor's checklist. Designing techniques, assessing the control environment, seeing, is there a possibility that income that isn't currently due in the period of account that is being reviewed is somehow being recognised in that period. I think the instance, Tesco, that you alluded to, that had this as a big factor in that scandal, didn't it? That rebate that should have been recognised in the future was being brought forward into the current period.
Yeah, and I think when you follow the cash, it's and what I mean by that is, this isn't cash accounting. This is, if I've accrued, for argument's sake, 1 million to pay out rebates to my customers, look at the cash payments going out to pay my customers for rebate, because especially post audit review, because you might have audited and said, yep, we agree 1 million based on the testing we have done, but is it complete? Because like we said, you've got that siloed issue, and if your sales team haven't told you about a contract, the first time you generally hear about it is when you owe that customer money. So potentially it's a payment that doesn't even go through the balance sheet. So what you're going to start to see is rebates on the profit and loss account not going through a balance sheet, and you will see that in probably the first few months after the kind of year-end close. So look for rebates not going through the balance sheet, typically on a cash or a credit note, debit note basis.
Absolutely.
And then the other thing for me is make sure the receipts or the payables match the period they relate to when they do go through the balance sheet. So for argument's sake, look for 2024 receipts being coded to 2023 accruals and things like that. Basically hiding bad news with current money. These are all kind of sample testing, that kind of thing. But just, I would say that it's a good practice for an auditor to have those checks.
Yeah, absolutely. And you went into detail there on the rebates payable side. My experience in rebates receivable, these things do happen, as you say, the agreements that are made without proper communication, and you do get to the end of the year or just after when that rebate becomes payable, you haven't made an accrual for it, and yet cash comes into the business. Thankfully, your supplier has been honest and they've made a payment for that rebate that was contractually due, but you weren't aware of it. And if they didn't make that payment, then you may well have missed out on that income from the client's perspective. So these things, they do happen. Some people in the business will see that as good news. Oh, we've got more margin coming into the year than we expected. But we as accountants, we kick ourselves at that point, and we regret the fact that we hadn't been made aware of that income, and therefore we didn't recognize it in the correct period. So just a bit of an anecdote there that this does happen, and probably not deliberately. I think there are nefarious schemes out there where people use rebates to deliberately misstate the accounts. That isn't always the case, and so I think it's that control environment that we mentioned again, making sure that these things, when agreements are made, that there's a single source of the truth where they all get saved to. There's no denial, there's no question, no ambiguity about where the rebate terms live, and therefore there's a much better chance that the finance professionals can make the right accruals because they're aware of everything they need to accrue.
And I think what's really important here is when you make a sale, it goes to your ERP. Nobody has to worry about it. When you make a purchase, it goes to your ERP. Nobody has to worry about it. The next biggest transaction is a rebate. And unfortunately, that is not automated through your ERP, or it often isn't. And so the contractual element of a purchase, the contractual element of a sale, all housed in your trading platform, your ERP. This is why rebates tend to go wrong in these scenarios. And to your point, if you get cash after the year end that you didn't have an accrual for, you could say, well, that's great, but technically it's a control failure.
Absolutely.
And likewise, you'll see it exactly the other way. You will go out and ask for the rebate, and the supplier will tell you, well, actually, no, that contract was null and void
because of this email, this contract that replaced it, whatever it might be.
And so when you're auditing, again, you're looking at materiality, you're looking at these things, you're accepting that this is a complicated world, and you're trying to get overall comfort. I would say that what's really important there is, yes, you're following the cash and you're doing supplier circularizations or customer circularizations. In many cases, you can cover the bulk of the accrual with a small proportion of the kind of the audience.
Yeah, absolutely. And just to reiterate that point that you made, about the rebate calculation almost always sitting outside of the ERP. The assessment of the ERP, understanding its capabilities, its limitations, that's kind of standard for an audit. You'll do that. You'll assess, okay, what system they're using for trading and recording their transactions. It's not necessarily taken for granted in the same way that you'll put the same attention into the rebate calculation that sits outside of that system. And so I think going into an audit, assessing that control environment at the planning stage, it's really important that you are considering all of those complementary systems that sit outside of the trading system, making sure those calculations are robust, really spending your time there, making sure that you can place reliance on those systems.
And I think there's 3 potential silos in this process. You've got the party in your company who are negotiating these contracts. You have finance, and then you have the third party, your customer or your supplier. And in a perfect world, all 3 are aligned. What you want to see is regular communication between all 3, because these contracts are open to interpretation. They do exist in one silo and not in the others. There are different versions of these things as well. So when you're auditing, you really want to look, have they got good communication throughout all 3? And again, unfortunately, ERPs might do 2 of the silos, but might not do the third one, things like that. So, and spreadsheets, definitely you're only going to do 1 silo kind of thing. So then we move into inventory rebate provision, which is purely for the buyers, those receiving rebates from their suppliers. And I think we've got a couple of slides on that later that we're going to go through. But just as a header level, why is this so important?
I think we can link through from the first point about the ERP systems and the fact that transactions tend to get recorded at their gross value, the invoice value, the document that went through the system. And so taking the inventory valuation from the accounting system itself almost always doesn't take into account the rebate on those products. Problem there, as we all know, we need to value our inventory at the lower of cost and net realizable value. In this case, we're going to assume that we can sell that stock, that inventory, for more than we bought it for. So the net realizable value we can put to one side, and instead we think about that cost. But we know that that cost has to be the true net cost that we paid to our supplier, and therefore it needs to be that initially recorded invoice cost going through the system less the rebate that we're going to earn on that. And this is where we get that challenge of having an external calculation outside the system that needs to be weaved into all that data that sits in the system. But there are other challenges as well because of the variability of rebates. Then that scenario over the course of a year where, okay, we're forecasting to hit 1%, that changes to 5% and maybe back to 3%. It's a bit counterintuitive to think that our inventory value can change over time in that way, depending on the outcome of the forecast that we're making. But we need to have or the client needs to have a rebate in inventory calculation that's nimble enough to take account of those nuances and change with the forecasts in the rebate accrual and reflect that also in stock. So when we get to the year end and we're presenting these accounting records for audit, we are presenting the true net cost of those goods, taking into account the actual rebate that we did achieve in the year, not the one that we forecast early in the year and perhaps forgot to change later.
Yeah, and for me, this is it's an easy area to get wrong because you're so focused on making sure either you've got the right amount you owe your customer, or on this side, the right amount due from your supplier. This is almost just a timing thing. This is where you are just making sure you release the rebate to your profit and loss account at the same time as the cost of goods for those respective purchases are going through. The real challenge is keeping that in sync. And so I see different tiers of capability in that. And I know we'll go through a calculation shortly on that. So then we look at, and I love this term, substance over form. I tend to start talking about ducks and whether they quack and things like that. But what we're really talking about here, and it served me well in accounting, is anybody who's in audit, the chances are they're going to progress. I know that's your background. they're going to progress into the business at some point, and you're going to deal with commercial people as well. And they will tell you, because they're not accountants for starters, they will tell you how they think things should work. And it's our job to kind of break it up, understand it, and apply it as per the accounting guidelines.
Yeah.
We use the term substance over form. Can you explain a bit more about what that means?
Yeah, so it's reflecting the true nature of any balance or transaction, not just merely the form that it's initially presented to you in. The example you give is perfect, where perhaps a procurement manager comes to you and says that they have secured a certain term within an agreement, and in their mind it represents X. But if you take a step back and think, okay, actually, what does this represent? Truly, it represents something different. It represents Y. An example of this in the rebates world, I think we can think about lump sum fees, listing payments. Maybe it's 100K over the lifespan of an agreement. Accounting for that, I think if let's say 100K over 3 years, naturally as accountants, we instinctively respond, well, we should be recognizing a third of that 100K in each of the years. Might feel a bit different, and you might need to be a little bit more kind of aware of this substance over form question if the procurement manager comes to you and says, I've done a 3-year agreement, and in year 1, the supplier is going to pay us 50K, in year 2, 25K, in year 3, 25K. So in total, we've still got 100K over 3 years. And the substance of that transaction is no different to what we described initially, 100K over 3 years. But the payment dates could cause us to hesitate and maybe think about recognizing on more of a cash accounting basis 50K in year 1, 25K in year 2, and in year 3. But we need to really take a step back and think, is the payment date distorting the true reality, the true substance of that transaction, and maybe leading me to the wrong conclusion?
Yeah.
And again, the variability, the possible for different options, almost endless number of options in rebate agreements really throws up lots of these examples where you could trip up if you don't take that moment to take a step back and think about substance over form.
And I think that's one of the most common scenarios I see, especially if a business is trying to hit a set of numbers, is procurement teams maybe are tasked to go out, find some extra money. The question is that you have to ask yourself, what are they giving in return for that extra money? And that is always the case. You should match whatever so in your scenario, the requirement that was delivered was, I will sign a 3-year contract with you. What was given was 100K. Everything else in that scenario, technically, we don't cash account, so we don't worry about that. Now, there will be some scenarios where there are extraordinary circumstances, but generally it is, you match the requirement or whatever it is to the incentive or the remuneration. So the next one is probably one of the more challenging ones, which we talk about completeness. Which I know is a big word in the audit world. I think we've talked a little bit about this, but just to really kind of drill into this, why is this so important?
I think most auditors would agree this is where testing gets quite tricky. If you think of the other side of the coin, the opposite to completeness tends to be thought of as existence. So testing the existence of a balance. It's much more straightforward to have a list of items in a ledger and check that each one of them exists. You can check, okay, did we receive cash? Did we pay cash for that one? Can we trace it back to an agreement? There's lots of ways that you can test what's there in front of you. What's much trickier is thinking outside of that list and thinking, okay, well, what isn't here that should be? It almost seems like an impossible task. How can I find something that isn't there? But it's integral to being able to come to the right conclusion as to whether those accounts are materially misstated or not. So I think we've alluded already to some of the tests that help us in this area, that post-year-end review, looking at what happened after the balance sheet date. Does that then reflect what existed at the year end but wasn't recorded in the books? And as you say, following the cash is key there. We don't necessarily record the transaction when the cash changes hands, but the cash is a sign that something is happening. There is some agreement there which perhaps wasn't previously recognised in the accounting records. And so, I think it's that difficulty, and we don't intend to teach auditors things that they already know. That they know that completeness is a key assertion that they're testing, and that it's one of the trickier ones. But when it comes to rebates, again, because of what we've discussed, the fact that it is possible for things unintentionally to go unnoticed, for balances that should be recognised not to be recognised, it really is a key assertion in the audit of rebates.
And I think analytical review as well can help here. So, again, keeping it simple, take, whether it's suppliers or customers that you're looking at for rebates, take the prior year, summarize it by supplier, whatever it is, and then compare it and look at what existed last year that doesn't exist this year, and have a look a bit deeper as to why, especially if there is continued active levels of trading, because that would make me more nervous. And yeah, that for me is really useful in terms of comparing the two. And likewise, you can look for so what's new as well, because that, again, especially on the supplier side, lots of sudden new rebates, cash coming in. That, again, you would think, well, why didn't it exist in the prior year? Now, there can be explanations for this. You can change the operational structure. So price is typically, there's two sides to a price generally, the rebates and the discount at the front. And you can move the two around. But generally, businesses don't tend to do that too often, because it really does disrupt trading behaviors. One of our favorites next, obscure contract wording, which is a little bit about substance over form. But one of my favorites is when you see a rebate agreement, and there'll be a box that will define whether you get a rebate or not, and it'll say NA. I love it, NA, because it means, well, is that a no, or is that a no, or is that actually the other terms apply? I just like clarity in an agreement. And I've also heard it from many colleagues in the past, when you ask them, well, what does this really mean? And they say to you, well, what does the supplier do? How do they think of it? Now, I understand why ambiguity exists. It exists because somebody's scared to ask the question, just for fear of maybe the other side saying, no, that's not how I interpreted it. But if you haven't got that clarity, it's really dangerous. My advice to anybody who has this is speak to the other side, as in your customer or your supplier, because there's a good chance they'll interpret it in their best interests and you'll interpret it in yours. And it doesn't matter who is right or wrong, somebody's going to have a big gap in their numbers at the end of the year. So that, for me, if I'm an auditor and I see obscurity, the next thing I'd be asking is, well, what kind of dialogue are you having, looking at that supplier circularization or that customer circularization to try and then also what kind of dialogue are you having with your commercial colleagues to try and kind of reduce. I'd use the word eliminate, but I think, it's generally not the role of finance to tell the commercial people what to do.
I think from the audit point of view, our experience of being audited as finance people, I think inevitably we bore the brunt of those conversations, and obviously happy to do so. I think there is a lot that auditors can gain from having conversations with the salespeople or the procurement people that do the agreements, in terms of really getting to the origin of the terms and really understanding what was the intention when they were written down. So I think, broadening out those conversations and really kind of sending those inquiries into different parts of the business, not just using finance as a go-between to get that information. An example in this obscure contract wording that I like to use is from my experience in the past around marketing funds or marketing rebates. In previous roles, I've seen both kind of operating alongside each other, and to the uninitiated, a marketing fund and a marketing rebate probably sound pretty similar. Maybe would be assumed to be one and the same. But unless the agreement makes it very clear which one you're dealing with, there are two potentially very different things here. One intended from the supplier as a support for marketing activities, which when we think substance over form, you're absolutely right to link in substance over form in this area. When we think about that, well, that's a reduction to our marketing costs. And so in terms of classification, we'd expect that income to net down our operating expenses. Whereas the marketing rebate isn't truly marketing in nature, it's just another rebate. It's a reduction to the cost of the goods, just badged up as marketing. So substance over form there, that truly is a reduction to that cost, and so should sit in cost of goods sold, not in admin costs. So again, understanding exactly what does that contract mean will dictate what the client should have done with the accounting, and will lead the auditor to the right conclusion on whether that treatment was correct or not.
Yeah, and for that one, the marketing one, it's the provisions do provide some clarity on it, and the paper I wrote goes into it in more detail as well. But ultimately, if you're it doesn't matter what you call it. If you're handed a rebate and you can do whatever you want with that money, you probably need to account for it like a normal rebate. For marketing funds to qualify as a reduction of your marketing expense, you're probably looking for things like you need to actually incur the expense, send a copy of the invoice of the expense you've incurred to your supplier, or your customer sends it to you, to actually treat that as a reduction. So it has to be for the marketing relationship between the two. And yeah, it gets quite deep and murky, but what you're looking for there is consistent treatment of those kind of things, and a logical approach to how you're dealing with it.
Absolutely, yeah. And some may come at this, if they're not in the auditing world, and say, well, what does it matter? It all makes its way down to the bottom line. What does it matter that it's up here in the income statement as opposed to down here? But we're here to identify instances of material misstatements and classification between areas of the P&L or the income statement can represent misstatements. And the profit number might be correct, but it needs to sit in the right bucket up above.
And for me, that it's the inconsistency that would make me more nervous. It would be a business that's putting it in gross profit when it's suitable, and then down below, like you say, it's the same number at the bottom, but it has a very different impact on kind of your metrics.
The reader.
Yeah, so making sure that that's there. And then our final point, which happens more in some industries than others, and we've talked about it a little bit, mid-year changes or mid-contract changes, I think. And bearing in mind here that not every contract runs calendar year, and not every accounting period runs calendar year. I don't know if it's a blessing or a curse when they're aligned, because you get to the 31st of December and you've actually got to, the contract's ended, which means you don't know exactly potentially how it all ended up. Whereas if it happened a couple of months earlier, you've got the benefit of hindsight, and you've only got to estimate 2 months. Whereas in some cases, you're estimating 12 months at your year end. So the risk profile does change. But talk to me a little bit about why mid-year changes or mid-contract changes can present a challenge.
Yeah, they always did. And I think having felt the pain of dealing with these as a practitioner, I just had to include this as a risk area, because I know from experience how difficult they are to deal with. And you alluded earlier to a year-to-date rebate accrual. That's pretty common that we see that in any given period, the accrual that is being made is a year-to-date reflection of, based on current understanding of forecasts, etc., how much rebate do we think is due to us or due to our customers. And so if at some point during that period, say we're halfway through the year, in terms of our fiscal year or financial year, but then halfway through that 6-month period, the agreement term changed, it's very difficult in lots of accounting systems or lots of rebate calculations to reflect 2 different things happening within that one period. If you're dealing with sets of rates, maybe a supplier rebate percentage, applying two different percentages because there's essentially two deals running in that period is quite difficult. Isolating the data that is applicable to the old rates as opposed to the new rates is very difficult. And so as an auditor, I would keep an eye out for agreements changing during the financial period, just because it throws up those problems, throws up those difficulties of having to recalibrate and maybe do something outside of the ordinary. Because in an industry where these changes aren't common but do happen, the system will be built around an assumption that the terms do not change during the year. So when they do change, the suitability of those calculations is really tested.
Mm-hmm. And so I think, I mean, looking at the clock, I think as we start to bring this to a close now, I think if we look at kind of the next steps, so if we go to, I think the what can users do next, as in looking at the probably the guide that we've you know, that we've put together on accounting practices and standards, because I am mindful, like I said, we could talk for hours. And so what I would say is, when it comes to rebates, there are a couple of specific accounting standards, more so in US GAAP. They do get mentioned, but until I wrote kind of not so much War and Peace, but it wasn't far off.
Close, yeah, it's close.
Covering both US GAAP and IFRS. And what I tried to do was all of the points we've just covered, tackle them in terms of not the easy scenarios. We know how to account for them. It was more these challenging scenarios. And so to me, for any kind of anybody looking to learn more about applying accounting standards to rebates, looking to understand when's a marketing fund and when is it a rebate, when there's a mid-year contract change, how much money do you put into that year versus how much goes into future years, multi-year contracts, all of these kind of things. There is no book you can read that'll tell you you should do that, but there is this guide that will tell you, here's a framework you can apply. And so I don't know if we've got the slide up that goes to the in terms of that. It should be there. That's the one.
That's the one.
That's the one. That's the, now that, if you like rebate accounting, that is the guide. It's not, it's written in a way that I wanted it to be practical. Now, you can read this, and because we know substance over form, because we know principles-based accounting, some of the scenarios in there, I would encourage people to think however they wanted to. Because in my opinion, the beauty of accounting is you can form your own judgment as long as it is consistent, it is sound, justifiable. But what this does is it gives you a framework, as it says. It is a starting point. So I'd encourage people to have a look at that. I know you saw it a couple of months ago.
Yeah, before I joined Enable, I was still working as a practitioner in a rebate management role, and it's such a powerful tool. I think it's those scenarios that you mentioned, trying to put what we've discussed into real life examples that may crop up either as an auditor or even as an accountant trying to deal with rebates in the first place. I think it will resonate with people, and I used it to deal with a particularly tricky mid-year change to an agreement where an additional listing fee, a lump sum rebate, had been thrown into the mix. There was lots of moving parts in that scenario. Fortunately, it was actually outlined by yourself in the document, and therefore, it just gave me a bit of a grounding and helped me to work through that scenario in a way that's really difficult with the standards. The standards are great in that they tell you with a certain degree of leeway what should and should not be done, but there's no way that they can speak on every single possibility and really consider these real life examples. If they did, they would just be thousands and thousands of pages long, and we as accountants would do nothing but read them. So some real useful practical examples, scenarios that people will recognize that they have encountered, or that maybe in the future they will encounter. And having read this, they'll just think, oh, okay, yeah, there's a tool there that I can refer back to help me navigate through this tricky accounting scenario for rebates.
Yeah. Well, thank you so much. And so I think, with that in mind, and be mindful of time. Zach, have we had any questions that
we don't have any live right now, so I think we could end it. I'm just going to thank you both for doing a great job and giving this webinar, and thanks to everyone who was watching this live. For those who are watching live, here's a quick reminder on how you can earn your CPE for free for attending today's webinar.
Today's event has ended. To earn CPE, go to earmark.app or scan the QR code on the screen. Then log in or create your free account. Search for the course by tapping on the magnifying glass icon on the home screen and then entering the name of this event. It takes a few days to make the course, so if you're attending this event live, keep an eye out for an email letting you know when the course is available. Pass the quiz to earn your CPE, then tap the button to email yourself a certificate. Stay tuned for more events from Earmark. Thanks for joining us, and we hope to see you again soon.